Could Mosaic Co be the hidden gem in the global fertilizer market that savvy investors have overlooked? We've delved deep into their financials, from unexpected shifts in cash flow to bold strategic reinvestments, and packaged all our findings into this concise analysis. Join us as we reveal insights that could redefine your perspective on this industry heavyweight. Ready? Let's get freaky in those accounting sheets. Mosaic Company produces phosphate and potash fertilizers, nutrients critical for enhancing crop yields. Operating through its phosphates, potash, and Mosaic Fertilizantes segments, it offers products like diammonium phosphate, supplying essential phosphorus to plants. By also providing animal feed ingredients under brands like Biophos, Mosaic diversifies its portfolio. Positioned globally, the company plays a significant role in food security, a key factor in fundamental analysis. Analyzing Mosaic Co's balance sheet, we notice the debt-to-equity ratio steady at 0.4, implying moderate leverage that balances debt and shareholder equity, while cash reserves decreased to $301.6 million. Total debt increased to $4.278 billion, leading to a significant negative cash-to-debt gap of nearly $4 billion. Retained earnings stand strong at $13.915 billion, showing the company is reinvesting profits into growth, especially after successful product launches. This strategy of using debt to finance expansion could pay off if investments deliver returns. But investors should be cautious of the rising debt levels and assess whether the company's growth justifies the increased leverage. Here's a screenshot of the full balance sheet. Notably, the rise in inventories to $2.923 billion signals potential operational resilience or a slowdown in sales, monitoring how efficiently Mosaic Company manages. This inventory will be crucial for sustaining profitability and ensuring cash flow stability. In Mosaic's latest quarter ending September 30th, 2024, gross margin improved to 14.8% from 14%, suggesting better production efficiency. However, operating income margin, which reflects profitability after operating expenses, fell sharply to 4.1% from 8.3% due to higher raw material costs. This decrease raises concerns about operational efficiency, but management is addressing it through cost controls and supplier renegotiations. Net income margin stabilized at 4.3%. While earnings per share growth was flat, strong market demand and innovative products may drive future revenue growth despite supply chain challenges. Here's a screenshot of the full income statement. Mosaic's comprehensive income improved significantly year over year, indicating strong recovery. This suggests effective risk management, especially around foreign exchange and interest rates, enhancing long-term value prospects. However, net earnings trend calls for close monitoring of operational strategies. Although Mosaic Co's revenue saw a slight decline from $2.82 billion to $2.81 billion in the third quarter of 2024, the company's net income rebounded impressively from a $161.5 million loss to a $122.2 million profit. This turnaround suggests improved operational efficiency and effective cost management. The rise in operating income further indicates strengthening core business activities. Management's commitment to investing in new product development and market expansion appears to be mitigating economic headwinds. Investors should consider whether these strategies will sustain long-term profitability in a challenging market environment. Mosaic's free cash flow dropped to $72.1 million from $513.1 million last quarter, mainly due to increased capital expenditures on technology and infrastructure upgrades. This raised the CapEx margin to 197.1%, signaling significant reinvestment. The CapEx margin reflects capital spending as a percentage of revenue. A high margin suggests the company is investing heavily in future growth. While this impacts short-term cash flow, these strategic investments aim to enhance operational efficiency and sustainability, potentially boosting long-term returns. Understanding these moves is crucial when evaluating Mosaic's long-term value. Here's a screenshot of the full cash flow statement. Notably, Mosaic's net operating cash flow has decreased, highlighting potential liquidity pressures. This trend demands scrutiny as consistent reductions in operating cash could undermine their investment capacity and signal possible challenges in maintaining robust financial health. Despite recent challenges from hurricanes and potash mine issues, Mosaic swiftly restored operations, showcasing strong resilience. In quarter 3, they reported $2.8 billion in revenue and $122 million in net income. Adjusted EBITDA was $448 million, impacted by lower potash prices and a delayed agricultural recovery in Brazil, though strong phosphate margins provided support. With rising corn and soybean prices boosting farmer sentiment, fertilizer demand is expected to increase. Notably, potash prices appear to have bottomed out, suggesting potential for gradual price improvements. Mosaic's cost-saving initiatives and expanding biosciences segment could enhance profitability, indicating favorable prospects for the company's financial health. Analysts estimate Mosaic Co's net income will grow to $1.23 billion by 2028, with earnings per share reaching $3.70. EPS indicates how much profit is allocated to each share of stock. A rising EPS often signals a healthy company. These upward revisions reflect confidence in Mosaic's strategies, like integrating acquisitions and tapping into robust market demand. However, economic uncertainties remain potential risks to these positive forecasts. A proprietary Bow score places Mosaic's net income and EPS at the pinnacle of both its industry and the S&P 500. This exceptional performance underscores strong profitability and suggests significant value potential compared to peers and the broader market. Comparing key metrics with peers, Mosaic's PE ratio of 10.16 is notably lower than competitors like Nutrien at 22 and Corteva at 46. A lower PE can suggest undervaluation or lower growth expectations. Mosaic's PB ratio of 0.96 indicates the stock is trading below its book value, which may signal undervaluation. In contrast, peers trade above their book values. Management believes the market hasn't fully recognized Mosaic's growth potential and operational efficiencies, enhancing its competitive position. This could present an opportunity for value investors seeking undervalued companies with strong fundamentals. Mosaic Co's PE and PB scores of 75 indicate it's better valued than 75% of its industry peers and the S&P 500. This suggests potential undervaluation, making the stock appealing to value investors seeking companies with favorable valuation metrics. Our DCF valuation, which estimates a company's value based on anticipated future cash flows, projects Mosaic's equity value per share at $50.22 by 2028. Despite recent revenue declines, management foresees a return to growth by harnessing operational strengths and market demand. This indicates that the current market price may not fully reflect Mosaic's intrinsic value. For value investors, the gap between market price and projected intrinsic worth highlights a potential opportunity, provided the company successfully capitalizes on its growth prospects. Using our proprietary Bow score, Mosaic Co's less DCF valuation ranks below most peers, outperforming only 25% in its industry and 33% in the S&P 500. This indicates potential overvaluation, suggesting caution for value investors seeking stronger fundamentals. Analysts project Mosaic Co's stock to range from $26 to $44 over the next year, averaging at $35. Management predicts that ongoing demand growth and operational improvements will boost performance, potentially strengthening investor confidence amid current market volatility. According to our proprietary Bow score, Mosaic outperforms 100% of both its industry peers and the S&P 500 in analyst target metrics. This indicates strong analyst confidence and suggests significant potential for future investment returns. Mosaic Co's financial metrics indicate potential undervaluation. With a steady debt-to-equity ratio of 0.4 and strong retained earnings of $13.915 billion, the company shows financial resilience. Its low PE ratio of 10.16 and PB ratio of 0.96 compared to higher industry averages suggests the market may undervalue its stock. Significant reinvestments in technology and infrastructure, despite short-term cash flow impacts, position Mosaic for future growth. Management's cost-saving initiatives and expansion into biosciences aim to enhance profitability. Coupled with expected increases in fertilizer demand and analyst projections of net income growth, Mosaic Co presents a compelling opportunity for value investors. Make sure to watch another video from our Value Explorer series by clicking the playlist below.